Welcome back. We're diving straight into an analysis report on TILRAY's recent 10% dip. The argument? That this is a buy-of-the-year opportunity thanks to solid fundamentals and a big political catalyst on the horizon.
And it's a strong piece of work. It's well-structured, connects the financials to the news really effectively.
But, and there's always a but, its aggressive confidence sometimes gets in the way of the analytical rigor you'd want for a really bulletproof thesis.
Yeah, that's a good way to put it.
So let's start there. The whole thing seems to hinge on this one political action. They call it the rocket fuel, the holy grail.
It's exciting for sure. But, that brings us right to our first point. The reliance on this single political catalyst, it creates a single point of failure that really compromises the entire investment thesis.
Okay, unpack that for us. Because the fundamental story, that surprise Q1 profit, record revenue, that's pretty compelling stuff on its own, isn't it?
It is. And that's exactly the point. The weakness here is how the catalyst is presented. The analysis basically treats this potential Trump reclassification order as, guaranteed momentum.
A done deal.
Right. But it doesn't really talk about the timing, the actual probability it gets signed, or, all the legal and legislative hurdles that could slow it down, or even kill it completely.
So the whole argument becomes incredibly fragile. It's totally dependent on an external event that's completely out of the company's control.
Exactly. If that political timeline slips, the whole analysis looks wrong, even though that strong fundamental core is still there.
But hold on, isn't that the whole game with a stock like this? It's a high beta sector. People are specifically investing for that political speculation, right?
That's a fair point. But even the most sophisticated investors, the big institutional money, they demand modeled risk. They're okay with political volatility, but they need to know what they're holding without the catalyst.
Ah, okay.
If the rocket fuel, doesn't ignite, the analysis has to show that the rocket itself is still airworthy.
So the suggestion here is to strengthen the analysis by building in some clear scenario planning?
Precisely. Differentiate the outcome. What happens if the catalyst hits, and what happens if it doesn't? Right now, it feels like if the rocket fuel fails, the whole thing just plummets.
And giving the fundamentals their own valuation creates a much safer floor for the argument. It makes it more professional.
Absolutely. And to make that actionable, we'd suggest a couple of things. First, introduce a clear base case target.
Okay.
Let's just say, for argument's sake, $14. And that target is derived only from the improving fundamentals you mentioned. That surprise profit, the record revenue, the solid cash position.
So you're establishing a return that's completely independent of Washington, D.C.
Exactly. It validates the investment even if it's just in a holding pattern, waiting for news. It shifts the fundamentals from just being, supporting evidence to being the main engine of a real valuation.
That's a huge shift in rigor.
It is. And the second thing, develop a contingency case. Identify a specific financial metric that has to keep performing if that executive order gets delayed.
Like what?
Maybe something like accelerating gross margin or continued international revenue growth. You ground the short-term risk in the business itself, not in an election cycle.
That's very specific. It tells the reader exactly what to watch for when the political news goes quiet.
Right. You basically tell the reader, even without the political boost, the company is still worth X because of Y. The whole analysis just becomes so much more durable.
Okay, moving on. Let's talk about the tone. The headline itself is a lot. TILRAY crash, why this minus 10% dip is the buy of the year flash.
The energy is there, no doubt.
But it's so definitive. The use of this kind of urgent, almost promotional language, it risks alienating the very readers you want to convince, doesn't it? The ones who are looking for impartial analysis.
This is a really key point about audience. The weakness is that framing. You see phrases like single greatest buying opportunity of 2025, loading the boat here.
Fortune favors the bold.
Yeah, all that. And look, it's great for driving clicks and engagement in some places, but it blurs that necessary line between objective analysis and, a personal stock tip.
It's the difference between conviction and certainty. The data supports strong conviction, but the language screams certainty.
You nailed it. And that, unfortunately, can diminish the credibility of the actual data. That $1.5 million net profit is a huge deal. It's compelling. It shouldn't need that kind of salesmanship.
So the suggestion is to keep the contrarian by the fear angle, because that's effective, but to adjust the vocabulary?
Right. Focus on potential and probability, not on absolutes. Let the analytical confidence come from the data itself.
So how do you do that? What are some concrete examples?
Well, for one, you could replace a hyperbolic claim like crash single greatest buying opportunity with something more precise.
More analytical.
Exactly. Something like, this technical dislocation coupled with the Q1 financial turnaround presents an attractive, asymmetrical risk-reward profile.
That language still pushes for action, but it frames it intelligently. It speaks to someone who understands risk. And it sounds professional.
And it gives weight to the hard research that was clearly done here. And then the second thing, for the conclusion, instead of saying something personal like, I'm loading the boat here.
Which feels like a recommendation.
Right. Instead, you just summarize the facts. You point to the favorable confluence of the improving financials and the potential policy changes. Let the data do the shouting, you know? The analyst just needs to point the way.
That shift is huge, because the sophisticated reader, the one who really knows this sector, they want to be convinced by the logic, not by enthusiasm.
Absolutely. When you soften the tone, you paradoxically make the thesis stronger. You show objectivity, and that suggests the call is based on more than just emotion.
Okay, let's shift gears to the technicals. The analysis does a good job identifying the $10 support level and the analyst target of $17.83. It gives the reader a nice, clear range.
It's a solid starting point, no question. But there's a bit of a shortfall. It correctly identifies the support and the target, but it fails to connect that to the massive move that happened right before this.
The $21 super spike.
Exactly. A more comprehensive bridge is needed to connect that recent high volatility to the current price target of $17.83.
So if the argument is that this dip is just a consolidation, a cooling off period, then the relationship between this low and that previous high needs to be explicitly defined.
Precisely. That $21 high wasn't just some random number. It was a huge psychological event for the stock, a moment of peak excitement. So when you justify a new target like $17.83, it feels a little isolated. Arbitrary, even.
It feels like it's floating in space without context.
Yeah, you have this huge piece of recent volatility, this massive price event, and it's not really pulling its weight and justifying the current target.
So the path to improving this is to integrate that history of volatility directly into the technical setup. Use that high as a reference point.
That's right. You have to show why 1783 matters beyond just being a consensus number. And there are a couple of actionable ways to do that.
Okay.
First, frame that 1783 target, not just as what analysts are saying, but as a key technical retracement level. For example, show how it corresponds to a key Fibonacci level, measured from the $21 high down to the current low.
That's excellent. That immediately gives the target a measurable, technical significance that's rooted in the stock's most recent, most explosive move. It elevates the analysis from just being descriptive to being predictive.
Yes. And second, you can explicitly define that 1783 level as a kind of threshold. It's the level where the stock has to show sustained buying pressure to prove that this dip really is just a consolidation.
And not the start of a bigger breakdown.
Exactly. Before it can even think about retesting that $21 high.
So $17.83 stops being a static goal and becomes a dynamic signal, a measure of bullish commitment. That completely changes how a reader would use the analysis.
It does. By tying in that past volatility, you give the reader a much richer story. You complete the narrative arc of the stock's recent journey.
Okay, so that was a really focused look at this TILRAY report. We've covered 3 critical areas that really impact how persuasive and durable the thesis is.
And it's important to say again, the core analysis is sound. The grasp of the financials and the market catalyst is there. The work is good.